Welcome everyone. I am CA Gaurav Garg from India, and in this video, you will going to see discussion on impact of COVID-19 on transfer pricing. And I can assure you it will going to be very interesting. We're going to have global perspective. In this video, I'm thankful to the professionals who have joined. We have professionals from different parts of the world, starting in alphabetical order. I have Belisa with me. Belisa is from Argentina. Then we have Charles Lienard from France. Then we have David from UK. Then we have Jaydeep Menon from UK. And we have Nipun Arora from Singapore. All of them are very experienced transfer pricing professionals. David and Charles carry almost 40 years plus experience in tax and transfer pricing. Belisa carries 20 years of experience in transfer pricing. Nipun and Jaydeep carries around 15 years plus transfer pricing exposure. I'm sure this video, this discussion would going to be useful for all of us in navigating in COVID-19 position when you are handling your transfer pricing policies or documentation. Let me, without wasting too much of your time, let me start the discussion. And one of the first topic that I would like to take is, which is impacting all of us, is the overcapacity. Because of COVID-19, we all know that there is a lockdown in different parts of the world. Manufacturing units are not able to manufacture. Distributors are not able to sell. There is a problem everywhere. There is an idle capacity lying with the manufacturers. There is stock lying with the distributors, which may eventually lead to the loss-making scenario at the end of the year, which may run not only this year, may continue for another year because of the economic recession that is coming up. So, Belisa, what is your view on this, and how you would going to advise all of us in C19 situation, that what kind of comparables we need to focus, how we need to document, what justification we need to build for this loss-making scenario which is arising because of C19. Belisa, over to you.
Hello everyone. Thank you for the introduction. Yes, the situation we are living nowadays, it is unprecedented and extraordinary. And this it's impacting company from different parts of the world in a different degree. Some of them we should be careful that they are impacting very disfavorable impact, and are suffering, as you said, losses or lower profitability that this situation will impact in their financial statement when companies have to prepare their transfer pricing documentation. In particular, companies with fiscal year ended December 2020 will be impacted with this financial and economic crisis, and will have to justify their intercompany transactions in this scenario and demonstrate that the particular situation is the principal cause for this result, and not the intercompany transactions themselves. That is, if you are having intercompany transactions, you will have to test each of intercompany transaction, and a company will have to be very careful to document by the time doing, that is to say right now, all the decisions made and all the document that then can be used to demonstrate that maybe the loss that are suffering are not a product of the intercompany transaction, and instead of this particular situation. So the first advice to all the multinational entities is to start right now to keep all the documents that can be helped in future audits that probably tax authority from all over the world will start reviewing transfer pricing and all the transfer pricing arrangement. And so the first advice, as I say, is to keep all the, for example, boarding meeting, the minutes, the emails, all the agreement as let's say, pre-COVID situation and post-COVID situation, and all the let's say the available realistic option that company may have available. For example, we should think about what third parties can do in a similar situation. Sometimes a third party may prefer to continue bear some losses, thinking that after the crisis there will be no competitor, and this means that this company will have a bigger market share. So you think you have to think of how third parties could act or perform activities in a similar situation. So the loss in itself, it's something that also will occur with third parties. The point here is when you are performing the benchmarking analysis, and probably you use, for example, the TNNM methodology, using a set of comparable companies, this will be a challenge for all the transfer pricing professionals, because firstly, it will, depending on the time of the professional is performing the benchmarking analysis, but it's quite frequently that you don't find financial information for the current year. So in the situation for a tested party that will be testing fiscal year 2020, maybe for the time when it's preparing the benchmarking analysis, you will not probably find the same financial information for the comparables. So this is a difficult issue, because if you don't have the same fiscal year for the comparable, probably your comparables will be not showing the consequence of the pandemic. So probably you may test a fiscal year of the tested party 2020 with, for example, 3 years for the comparables, which refer to fiscal year 2019 and earlier fiscal year. So in those fiscal years, the comparables will not have experienced the losses that probably your tested party did. But even if you find, because sometimes depending in each country where is the deadline to submit the TPE local file, maybe you can find such information for the comparable for 2020, but this particular year, the benchmarking analysis will have to be with more detail than before, because as I mentioned before, the crisis of the pandemic impact in different industry at a different degree. So some industry could be impacted worse than others. And even in the same industry, depending on the product and the market where the product is being sold, the effect will be different. For example, if you have a manufacturer of liquid soap that is actually very used by the public in general, this manufacturer will be impacted favorably. But if another manufacturer of liquid soap is performing its production for hotel, for example, this other manufacturer will be impacted worse. So you have the same functions, maybe the same product, but different market. And this type of consideration should be taken into account in order to perform a sound benchmarking analysis. So one of the advice could be to try to use, well, the same type of, as usual, same function, same product, but also in this time, it would be important the geographic market and also the market where the products are being sold. And so when you are performing the benchmarking analysis, maybe you will not can use the same comparables as being used before. Maybe you will have to change of the set of comparable and review the benchmarking study. Another thing is that it is quite probably that the tested party must have to perform adjustment to its financial statement in order to demonstrate that the extraordinary expenses and costs due to, yes, overcapacity, maybe compensation to employees, and other extraordinary expenses are caused due to this extraordinary event. And in this point, the OECD also recognized that when there are extraordinary scenarios, you can extract or apart from the TP analysis. So that again, this is important for the documentation for companies to have all the numbers documented, showing the loss or the lower profitability. For example, if it is a production company, maybe a good documentation may include how the production was getting lower and how this impact in the lower income. Or as I mentioned before, to try to quantify the extraordinary expenses and costs, and how the overcapacity is impacting in the financial of the tested party. One point to this, also important, is that when you perform the adjustment to the tested party, it is generally or ideally that the same situation you should check on the comparables. So if you are going to perform an adjustment due to overcapacity, the ideal situation is to test or to verify that situation in the comparables, to see if the comparable is performing the same or similar kind of adjustment in their financial statement or not. And this, well, in Argentina, we have a crisis some years ago in 2001, where we have this situation where we experience a very complicated crisis, and a lot of company experience overcapacity and extraordinary expenses, such as dismissing of personnel, and these companies perform this kind of adjustment to their financial statement. And later, the tax authority here in Argentina challenged those adjustments due to this reason, because it was not possible to prove the situation in the comparable companies. So in this audit, tax authority asked the taxpayer to provide them with the annual report of each of the comparables, and to look for such particular information. And in some cases, this was not possible. For example, when comparables are from other countries, from Japan or other Asian countries, where the annual report couldn't be found in English. So to check this information was impossible. And well, these type of cases ended in trials, and are still discussing some of them. So that is the importance to, when you are looking for comparable, to try to document all the information possible about each of the comparable. One other thing would be to use comparables from the same or similar market, in order to be more sure that these comparables can be suffering the same situation. Another thing, another option could be to use another method. For example, going instead of a method checking the net profitability as in the TNM, use at a gross margin level. But as we all know, this is complicated when you are not having internal comparable, and you have to test the gross margin with external comparable companies. These external comparable companies may have differences in their account related to expenses and costs. And so the comparison with the tested party will be difficult, in the term that you are not getting the same items in the cost as in the comparables. So it is the gross margin method is preferably when you have internal comparables. If you have a situation where the tested party has operations similar to third parties and with relative parties, you may perform a segmentation of the financials and then check with internal information the gross margin in one segment and in the other. This could be a good option, but you have to have these internal comparables available, and sometimes it is difficult. Another things could be in the same way to use caps, so comparing prices instead of margins. But again, the ideal situation would be that the same tested party have this kind of operation, the same type of, for example, import of product from a relative party and import from third parties. And in this situation of pandemic and downturn, maybe the conditions agreed with the relative party and the third party can be different due to the urgency for the tested party, in this case, to obtain such raw material, for example, that need for production purposes. So if you are going to use caps, it will be very important to check if the conditions between third parties and relative parties are similar, and really you can use these comparables. Another option could be to, in terms of the number of years to be taken to analyze the tested party. In some countries, there is the possibility for the tested party to take not only one fiscal year, by instance, make an average, for example, for the 2 or 3 early years. So you can, instead of performing an adjustment for the fiscal year 2020, maybe the solution would be to take the previous fiscal year and make an average and present those average results in comparison to the interquartile range of the same margin or for the comparables. But in some countries, like in Argentina, this option is not available because it is compulsory for the tested party to take only the fiscal year under analysis to test the intercompany transaction. So for Argentinian companies, for example, they will have to test fiscal year 2020 itself for test intercompany transaction. So in this situation, or in this kind of situation, another alternative could be to take only 1 year to the comparables. The other way around, if I use fiscal year 2020 for the tested party, try to use the same fiscal year 2020 for the comparables. But this, as I mentioned before, it may be difficult since when the time you are performing the benchmarking analysis, maybe this information 2020 for the comparable is not available. So it will be a big challenge how to analyze this loss situation in the companies all over the world. I think, to not extend too much, I think this is the main issues. And as I said before, the important thing here is to document everything. By the time being, try to document all as much as possible in order to have all the elements for defense when maybe the tax authority perform audit on this particular year. Another thing that it is important to document is the industry analysis, because sometimes in the TP report, the industry analysis it's not having the importance that merit. And in this particular situation, it would be very important to have a sound industry analysis explaining the global situation and the country-specific situation and the particular of the industry where the taxpayer is acting, because all this detailed information will benefit from this data to explain the loss in the taxpayer and also to perform the adjustment that probably will be needed to perform to the testing party. So I don't know if someone of you would like to add something else.
Thank you, Belisa. So after hearing you, I'm personally of the view, that I got confused how to benchmark because we may not be able to use TNMM because of the inavailability or non-availability of the financial information, as you rightly pointed out. But if we do not have internal comparables, then benchmarking using price-based method, comparable and controlled price, or gross level benchmarking may again be a tough scenario. But what I can make out is that unlike previous years, or unlike earlier years wherein TP was more or less like a statistics, we are computing our profit, finding the profitability of comparable companies and benchmarking. Probably this year, the more in-depth analysis is required on financial information, on financials of the company, to dig out what are the abnormal expenditure that company has incurred during the year, which pertains to external factor, in particular to C-19 or pandemic. Uh, Now I will come to Jaydeep. You have something to contribute. You have been to India earlier. Now you are based in UK, wherein financial information is not available. And it's very rightly pointed out by Belisa that when we are going to benchmark, when we are going to compute uh, profits for the purpose of tax, taking comparable companies into account, at that time we may not have the current year financial statements of comparable companies. So if you can particularly speak on this issue and other issues which you feel are important in
Yeah,
relation to what Belisa spoke.
yeah, thank you, Gaurav. I think what Belisa and you mentioned is very important. Uh, I think if we go through the different phases of the impact right now, right now we are probably most of the economies are in the survival phase, and then we some of them are in the kind of recovery, and it'll take a long time for normal phase to come in. So I think in all these phases, one common thing I think is important is about documenting what's happening, the story, what is happening with the company. That's very important. Even the USIRS has put in some FAQs last month on this aspect. Uh, so at the end of the day, it's not about just playing around with some comparables. Uh, those things may have a different number for each year, but I think the story has to be built up and monitored throughout the year, and it has to be documented upfront, so that after 3 or 4 years of when the audit happens, there is a good story or a justification for what has happened, and that would be more important than playing around with some comparable companies and see whether the company's margins or markup will fall in the range. In terms of benchmarking, you mentioned that's a very interesting topic, right? So because at the end of the day, uh, uh, if some of the countries have a range concept, right? So the US generally follows the interquartile range. India has a different range, not the interquartile. Uh, uh, However, some countries like UK follow the full range concept. So uh, I think for these years where it is impacted by COVID-19 implications, I think for these years, it is worth for the different tax authorities to consider whether the companies can use the full range concept and allow companies to wherever they're affected, allow companies to go the lower end of the range rather than somewhere in the median or in the upper end of the range or even the interquartile. So if that flexibility is given to the taxpayers of uh, for allowing themselves to fall somewhere between the lower end and the median of the full range, that'll be very helpful for the companies, particularly for some of the industries which are affected by COVID-19. Say, for example, the automobile industry, right? So some of the European automobile OEMs are were already affected by the economic downturn, and they were still trying to be on the recovery mode. So if you see the application of transactional net margin method in those jurisdictions, you'll find that some of the comparable margins are in the range of 1 or 2% or even less than that. So if there is an option to use a full range instead of an interquartile or any other tighter ranges, I think that'll be very helpful. And I think that another concept which were there part of the US IRS FAQs on the transfer pricing documentation was kind of a self-assessment concept. What it means is that I think the taxpayers can do a kind of a self-assessment of their policy throughout the year and see how their margins are sensitive to the comparable margins throughout the year. So some of the companies set their policies 1 or 2 years in advance, right? So the policy for the current year 2020 or 2021 might have been set in 2019 or with 2018 comparables as a planning exercise. So these are very important for companies which have undergone a change in transfer pricing policy or kind of undergone a restructuring exercise. So they would have set up the policies 1 or 2 years back. So if there is a flexibility for the taxpayers to just go through those comparables and see which of those comparables have really undergone the similar implications of COVID-19 as compared to the taxpayer, and allow the taxpayer to remove or include companies which are similar to their fact pattern of getting affected by the COVID-19 implication, allow that flexibility to change the comparable set which they have used for the planning exercise. That would be a great kind of exemption which the taxpayers can get. This is very particularly important in case of a APA, advanced pricing agreement. Some of the advanced pricing agreements were set with a set of comparable companies in mind, and they would have been kind of leveraged for a lot of the APAs which were signed. But if 2020 to 2023, say for example, are part of the APA period, I think it will be of great kind of an exemption for the companies or the taxpayers to relook at the comparable set which were considered for the APA program, and then see whether some of the companies are really reflecting what the taxpayer is going through. If they are not reflecting what the taxpayer is going through in the current years, then ideally they should not be considered in part of that set. And we should see what would be the impact on the margins and the markup if they are removed. So that will be a kind of change which I see from a benchmarking perspective. Another important thing I feel from a benchmarking perspective is the flexibility in using the comparable uncontrolled price methodology. As we all know, the strictness of using a cup-based methodology is very high. The kind of comparable conditions which we need to use a cup is on a higher side, that it has to be a kind of exactly similar conditions to use a similar price arrangement. So if there is a flexibility of relaxing some of those conditions, and we are able to use a generic cup arrangements or a kind of internal generic cup arrangements, I think that will be of great help to the taxpayers who are having loss issues in their financials. So if they are able to justify the transaction-wise details using a generic cup with some relaxed conditions, I think that's where the taxpayers will have some flexibility to decide the pricing and go about their transfer pricing planning.
Thank you, Jaydeep. Very important point in relation to API, I must say, and otherwise also, because many a times, as you rightly said, that the pricing policy have been set earlier based on certain comparables, and now whether those comparables are reflecting the current situation or not is important to analyze. I'm just wondering, with so much of analysis that is required in this C19 situation, whether transfer pricing consultants would going to get the higher fee for the amount of time that we need to put in, or because of the C19 client may say, no, I want some discount from you. Let's see how things will progress. Thanks, Jaydeep. Now I should come to David. David, I have,
Everybody.
because of this C19, there is a cash flow crunch which might be there in different group companies, and there could be certain financial transactions or circulation of cash that may happen in addition to the current financing arrangements or current guarantee arrangements. If you can please enlighten us on the current, the impact on the financing arrangements, including the guarantee, and also, the circulation of cash that may happen in the C19 situation. Over to you, David.
Thank you. We see that it's a key issue that multinational corporations are facing in the crisis is how to finance its operations. Corporate treasurers have been put under immense pressure to put together financing packages with its group companies and financial partners. Luckily, by coincidence, the OECD has published a report called Transfer Pricing Guidance on Financial Transactions. It is an extension of the work of the BEPS programme on interest deductibility, transfer pricing documentation issues. I don't know if what we've done is found some tips you can give to clients to help with keeping in the OECD guidelines. Again, the number one thing that comes on top of the agenda is documentation. How we implement financial support and group guarantees. We need to plan maturity dates and repayment schedules. We need to check borrowers' ability to repay the financial assistance. Avoid injecting financial support that could be reclassified as capital. And need to determine funding conditions in light of market conditions. These are just highlights we've taken from the OECD guidelines that are very relevant to the current situation. Because what we've got to remember is today's prices will be audited in 2 or 3 years' time, and hopefully at a time where the economic and health crisis is no longer critical and tax authorities are out there looking for money. So now's our time to get the documentation in place to support our pricing of our financial products. The other thing, there's more things that have come from the OECD guidelines. They've said that it's necessary to check the intergroup financing is the most reasonable option for the borrower and assess the ability to repay the money. It's also asked to look at whether local financial assistance is available, very unlikely in these difficult times. The other thing to document is describe in detail functions performed by the entities in the transaction, starting with the guarantor, who takes market risk, who takes hedging risk. Again, more things to document. Identify the financial capacity to incur risks. It shouldn't be necessary to monitor and enforce control of financial capacity. It's like an external financier. One thing that has also cropped up is having to document covenants in intergroup contracts, which is quite unusual. And we need to monitor the conduct of the parties. It represents what the contracts and accounting entries. We've come up with a phrase called triangle of compliance between the behaviour, context of group contracts and accounting entries. So it's very important that we get this documentation right, that we can support all our lending decisions. And we've got some good guidance now from the OECD on how to do this, which has not been in place in previous years. That's really any discussion points, please.
Yes. Thanks, David. You know, you mentioned about lending decisions. Uh, so if you can, Charles, if you can contribute something on, the documentation which David just mentioned about lending decisions, that how to strengthen those documents. Because if I have lended in earlier year and there is a continuing loan arrangement which is going on, and now there is a bad situation, do I, what documents that I may be required? And in addition, do I need to relook into the interest rates for those lending arrangements? Charles, over to you.
Thank you, Gaurav. Um, um, okay. If there is any taxable income left in 2020, for the companies who have taxable income in 2020, the challenge for the tax authorities will be to reject the deduction of potential intragroup funding, intragroup interests. And now they have a clear roadmap on how they can behave, how they can assess any intragroup funding transactions. Like David rightfully says, the deductibility of interest was already captured by other tools, other local tax rules. But in terms of transfer pricing and in terms of documentation, I come to your answer in a minute, to your question in a minute, Gaurav. In terms of documentation, now it's clear cut on, it's very explicit on what a company has to provide. Well, first, it's a good time for revisiting the quality and the extensivity of the documentation of intragroup funding. Contracts, of course. It's not rare to have intragroup funding contracts. I mean, it's quite common. It's quite rare to see sometimes a very thorough functional analysis of an intragroup funding operations. So that now it's clear cut that not only the contract but the behavior of the intragroup funding company has to be clearly detailed and analyzed. So based on this document published in February 2020, just before the COVID hit us, which didn't help for the publicity of that good paper, it's the right time to revisit the contracts and the documentation of this intragroup funding, intragroup captive of reinsurance and insurance captive, of the intergroup guarantee fees, of the treasury companies providing hedging for the rest of the companies. So all these financial transactions intragroup, it's a good time to have a rethink and have a, maybe for the ones who are very good already perfectly documented, to have just a check the box exercise. Have we complied with everything that OECD is requesting from us? Because no doubt, like David says, no doubt that in 2 or 3 years' time, tax authorities in need of money for balancing the budget of the states, which are going to be heavily hit by this crisis. They're going to go after money, and this is going to be a low-hanging fruit to assess if the contract does not reflect the behavior and if the behavior is not properly analyzed. So it's a good time for having a check. What do you think, Dave?
And we've now got the tools to be able to do the check where we didn't in the past. We had very limited OECD guidance. The only place on financial transactions we could find was in the permanent establishment guidelines.
Yep.
It's a great time to recheck as well.
I think very important thing that both coming from David and Charles, that it's a good time uh, that we must go back and check the behavioral aspect vis-a-vis the contract. You know, what is the substance over form, and whether both are in sync or not. And if they are not in sync, probably we need to build the right documentation. Maybe we need to have right contracts to reflect the behavior, and also to revisit the pricing of loan transactions or funding transactions. Uh, One small question, and maybe very important. Uh, let's say if the headquarter tries to arrange fund, and this question is to both Charles and David, if tries to arrange fund for the subsidiaries who are in cash crunch, uh, they may do it either through the equity, or they may either do it through the short-term funding via loan. So if they're doing it through equity, then certainly, interest payments are not required. But putting it in the form of equity means blocking the capital. And if they're doing through funding via loan, then it means you need to charge interest from your subsidiaries, and they may not be in a good financial conditions. So I'm just want to understand: is it possible for headquarter company to take a stand that this funding is a kind of a shareholder activity to protect its own interest and charge no interest or a very low rate of interest?
Yeah, I've seen this before, not just in crisis times, where you can justify a low rate or an almost zero rate in order to subsidise a subsidiary, give it financial support. Not in every tax jurisdiction, but one or two tax jurisdictions. I believe France may be one of them. The other interesting issue, like Gaurav, is if the group gets 0% loans off the government, whether you can pass that benefit off to the subsidiaries. If you're using cost of funding as your key way of setting interest rates. It's really an open question for me. I'm not quite sure how to answer it yet. But a lot of states are now providing interest-free, massive loans to their big industries. Are they then going to charge interest on that loan to the subsidiaries? Again, another rhetorical question.
But, the loan, I'm just thinking, and the loan which government is providing to the local companies is probably for the local use and not to pass on to the subsidiaries, because every government is looking to develop its own economy. So the funding which is coming from the government should be, technically should be for the local use and not to fund the subsidiaries in need. So so can we take a clue? It's becoming important. The way government is trying to protect its own industry, can this be taken as a, I will say, the behavioral comparison? Can we do behavioral comparison on this? That as government is trying to protect its own industry, own companies, in similar way, being a group company, being a group headquarter company, I'm trying to protect my own babies. I'm trying to protect my own subsidiaries by giving them loan, interest-free loan, or loan at the very subsidized rate. What is the view, Charles and David? Your thought on this? I'm sure it is tough, but what is your thought on this?
Yeah, I often think as a group of companies, business is not just the business of its UK, it's just of the subsidiary. For example, the UK, a lot of the multinationals rely very heavily on income from the subsidiaries. If the headquarter company fails to keep those subsidiaries alive, its results are going to be dramatically impacted. We're talking about some really very large multinationals this week going to the government asking for loans. And cannot just be purely for their UK-based business.
Okay.
So I'm sure there will be an element in those loans that can be used to keep very important subsidiaries alive.
Okay. Charles, can we have your view also?
I think taxpayers want quick answer to be able to prepare, but tax administration wants to take time before to give an answer. So we might be able to rely on some guidance by the OECD by the end of the year, by December. But I tend to fully agree with David. When any large French manufacturer, which operations are 20% in France and 80% elsewhere, is begging an interest-free loan from the government, it is certainly not to maintain their expensive and beautiful headquarters in the west side of Paris, but more for the full group to be able to survive. And once you've lent the money at the headquarters, it's very difficult to buy a covenant from the government to say, well, it's just for your French operations. How much is that going to be able to be charged to foreign subsidiaries? Well, then, as David says, if you rely on your cost of funding to set your intra-group interest rates, and you take into account then the country risk, then yes, the 0% rate is going to impact your intragroup fundings. But there is quite a clear-cut view on one point you mentioned, Gaurav, is if the centralized treasury company of the group has to, being the headquarters very often in France, has to abandon some of its funding, then it's considered as equity.
Okay. So thanks, Charles and David. Let me now move on to another aspect. And this time,
it will be considered as equity. It's not today. It's not considered, but based on the February document, it will be considered as equity. The way it's phrased, that's it. Sorry, Gaurav.
No issue. Thanks, David and Charles. Now let me move on to the another, the important topic, supply chain. Because of C19, as Belisa mentioned, there could be overcapacity issue, there could be distribution issues, and which will eventually going to impact the supply chain. And also maybe because of the funding issues, the companies may try to consolidate certain parts of the value addition or supply chain in one entity, instead of 3-4 entities. So Nipun, what is your thought on how C19 is impacting supply chain of MNEs, and how to document and how to benchmark the same?
Yeah,
over to you, Nipun. Yes.
Yeah, thanks, Gaurav. So this pandemic has actually unleashed a supply chain crisis, and many organizations were actually unprepared to deal with disruption of such a scale. So it's a mass disruption that has happened in their entire supply chains, starting from procurement of raw materials and ending up to final sales and distribution activity, which will include manpower, logistics, and warehousing management and inventory management. So this current disruption is not a routine kind of a situation, for which risk mitigating strategy can be drawn up overnight, or even for which a plan B should have been in place with the entities. Now, this disruption has moved across the globe and is now forcing companies to rethink the strategy as to how to sustain their supply chains. So we have some examples in the past also where disruptions have happened. So if you recall, there was a volcanic eruption in Iceland in 2010, and then there was an earthquake and tsunami in Japan in 2011, followed by floods in Thailand in the same year. Now, those were very region-specific disruptions that happened, and companies were able to manage their supply chains by arranging for alternative supplies and managing their procurement strategies. But now the situation is absolutely different, wherein the entire globe is facing this pandemic and supply chains across regions have come to a standstill. Now, in this kind of a situation, what organizations may have to think is about relocating their manufacturing facilities, uh, getting into alternate manufacturing, relooking at their financing arrangements, redistribute the risks, undertake a detailed analysis of their cost structures, reset their go-to-market strategies. In other words, what I mean to say is the businesses will have to do a restructuring to survive this economic crisis. Now, for this purpose, what the businesses will need to do is, first of all, understand their key business drivers, which are, say, tangible or intangible, such as where the customer base lies, where the procurement locations are situated, where the critical marketing decisions are taken in the group, which entity owns the technology and IP, and which entity undertakes the logistics functions. So all of these aspects will need to be taken care of by the entities. So I'll just give you an example. There's a very popular Japanese casual wear designer who has stores across, and uh, the manufacturing facility of that designer is in Vietnam, and the Singapore entity manages the logistics and the marketing. Now, because of this crisis, entire manufacturing facility was shut, and therefore no supply was possible. So I was speaking to these guys. So what they are contemplating is they may want to shift out of Vietnam and go very near to the customer base where they have it, or they may want to keep that Vietnam manufacturing facility still there, but try and shift out manufacturing to some other location also. Now, what they do is they have their design library. Now, this fashion design label, they have their central design library. What they do is they understand the market perception, customer requirements, quickly take out the designs which are closer to that possibility and start the manufacturing. So now for them, say the Southeast Asian region will have different preferences, the Japan part will have different preferences. So they are now working on relocating their design function and relocating a part of their manufacturing. Now, this will require a lot of rejig from the TP policy viewpoint, because all the intercompany agreements will undergo a change to match with the actual substance. Secondly, the risk profiling of the entities would also undergo a change, and therefore their compensation models may also undergo a change. Thirdly, when the shift happens, there may be a possibility that the exit charge may come into play, because if we are stripping down the functions or risks of certain entities or reducing their profit earning capability, that may warrant an exit charge. So these are some of the justifications which may be documented by the entities when they do this restructuring activity. I'll give you another example. So there is a huge entity which is undertaking sale of branded and high-end furniture in Singapore. Now they get their manufacturing again done in Vietnam, and now they have decided to shut down the Vietnam manufacturing facility because they were exporting all their manufactured products to the European region. Now their sales entities are based out of the European region. So now what they have decided, they'll shut down the manufacturing in Vietnam and take the manufacturing to some part of Europe, say maybe Germany or Poland somewhere, so that they are able to be close to the customers and the supply chain disruption doesn't affect them too much. Singapore will continue to manage, say, the marketing and the logistics, but then some part of marketing will have to shift out again to the European region. And therefore, the important point here is where the critical decisions would be taken. Now, suppose today the critical decisions are taken in Singapore, therefore the sales and marketing return accrues to the Singapore entity. And tomorrow, if I were to shift out my critical decisions, key management personnel out of Singapore to some other location and strip down the Singapore entity to, say, a marketing support service provider, then I may have to relook at the TP policies and again the potential going forward. So all of these TP policies and changes that happen have to align with the FAR profile, which is the function, asset and risk profile of the entities. The intercompany agreements have to be amended so that they are in alignment with what actually the entities are supposed to do. And then tax implications and regulatory implications are also important to understand where the functions need to go, where the risks need to lie, because it has to be clearly documented which entity has the capacity to undertake the risk and financial ability to overcome those risks also. And similarly, if the entities have already signed some APAs or intend to go in for an APAs, the critical assumptions need to be worked out accordingly to make sure that it is in alignment with the policy of the group. The other part which is important here is the documentation part, because once the group has decided to undergo a realignment of functions, realignment of policies, everything needs to be documented, because 2 years down the line, this COVID-19 would be a bad dream for us, and we would have, overcome these things and would have continued to our normal business activity. At that point in time, remembering what happened, why these changes were made, no one would know and no one would be interested. So documentation is extremely critical today. So for that, maybe each entity needs to appoint a person in charge who will take notes, who will do the write-ups today itself when the things are actually being undertaken. Whatever is planned ahead, the plans should take into consideration the strategy that has been framed by reframing of TV policies. Secondly, the planning aspect. So once the TV policies undergo a change, how do we do the price setting for that? What are the assumptions we are taking for changing the prices? What are the critical assumptions that we intend to take going forward, say 2 years down the line? All need to be clearly documented so that when the tax authorities carry out the audit, we have the necessary documentation in place to support as to why we undertook a change in the supply chain and what prompted us, because it's the business who has to decide how they want to conduct it. But it has to be aligned with the TP, the pricing within the entities also. So the TP part and the business part have to go hand in hand to make sure that whatever decisions the business is taking for realigning their strategy and the functional part, the TP part is also taken care of along with that.
A very important point, Nipun. Now I can see a lot of low-hanging fruits for the tax authorities, whether it's low profitability, whether it's funding arrangement, and now the business restructuring, which you're talking. Maybe I personally believe exit charge would going to be one of the main issue, that may arise because of the business restructuring. Belisa, you have something to say on the change in FAR and how do how companies are going to benchmark?
Yes, in fact, well, it was very clear as mentioned recently. The part of documentation is very, very important, and all restructuring decisions should be documented by the time being. And also, as said before, the issue of planning also should be doing in the time being, and with considering the transfer pricing point of view, because all these transactions will have a consequence on the transfer pricing transactions, and the relocation of function, assets, and risks should be specifically very well documented before the restructuring and after the restructuring, and how this new realignment of function, assets, and risk will be remunerated, and also if there is any consideration about the restructuring itself, to if some, for example, if in a group of company there is one entity incurring in losses and has to be relocated to another, the activity has to be relocated to another group entity, one can ask if this should be remunerated to that particular company which is adhering the new deficit activity due to the benefit of the whole group. That means maybe the whole group needs that particular activity which is now incurring in losses, and maybe the restructuring needs a compensation for that company of the group that adhere that activity. Or, for example, we will have, I think, a lot of cases where you have the contract manufacturer or contract service providers or distributors with limited risk that are in general compensated by a fixed margin by the group. And now with this situation, maybe it would be difficult for the group to maintain those margin already established in the agreement, and or couldn't provide that remuneration to this kind of limited risk companies. And in this regard, I think tax authority from all the world will not accept to be reduced this margin due to if these companies were characterized as a limited risk entity and receiving the past a fixed reward, not participating when in the profit of the group. Well, now tax authority, I think, will be in the opinion that they needn't, they don't need to bear some of the losses of the group. I mean, the transfer pricing policy of reward this company as a fixed margin, it's related to this specific limited risk aspect. And if it are not participating of when the group have benefit, well, it's supposed that it doesn't have to assume the losses where the conditions are not so well for the group. But as we are all saying, the important issues here is to document everything, and maybe to look in the intercompany agreement if there are some exemptions, like exceptional situations that can allow to change this kind of risk, and how to share the risk in some particular cases, like the one we are living now. I think that is important to have everything documented, and always thinking the consequence in transfer pricing for documentation and the fiscal year, and also taking into account the planning and how the following fiscal year will be also, how this can continue, because next fiscal year we should not forget about all those situations, and we have to make a follow-up of all these conditions, and if for example, if there are relocation of function, assets, and risks, if there are effectively change in the remuneration on this type of activities and functions of these companies that were realigning or modification.
Thank you, Belisa. Uh, we have done a lot of discussion, and in India, this reminds me of one thing. Uh, Jaydeep and Nipun both are from India. Now they are not in India, but they must have remembered that some years back, one movie came from the Bollywood. So we have Bollywood like Hollywood. We have Bollywood. So one movie came wherein the question was asked that what audience wants, and the lead actress replied, audience wants entertainment, entertainment, and entertainment. Now, if somebody asked what C19 wants, the answer would be documentation, documentation, and documentation. So now, David, uh, see, you have been to corporate for so many years. Uh, Nipun talked about restructuring. What do you feel, in if couple of issues which you can highlight that corporates may face while restructuring uh, the transactions or restructuring the operations? David, are you there? David? Yes.
I was muted.
Yeah. So what is your view, David? You have been to corporate for so many years. You left corporate at a very senior level. Nipun just mentioned that because of C19, the companies may go for a restructuring of their operations. If you can highlight a couple of issues, two issues which may make this restructuring tough. If you have, would you like to contribute on this?
Well, most of the restructuring was done without too much tax input, to be honest, when I was working there. It's very much a commercial basis. Our biggest issue was staff relocation and staff redundancy, to be honest. It was always given to the tax department at a later date to really sort out the supply chain differences. I think that's where we now, when we talk about supply, it's very good that nowadays tax people are brought in at an early stage to help in the structuring and get the right result. I mean, the other issue from a tax perspective was withholding taxes. Flowing of finances was a big issue because the group would put in place a very nice supply chain, but sometimes couldn't get financial flows to work because of exchange controls, withholding taxes.
Great. So Nipun, coming back to you, for everyone, this restructuring may not be an easy task. So would you like to say something, based on your experience, merging it with transfer pricing, that what are the key important thing one needs to keep in mind while restructuring the transaction? Quick 2 to 3 minute notes on this.
Yeah, see, I interacted with a lot of businesses here, and see, they think like a businessman. So they are seeing like if we have established a certain supply chain and now we are facing difficulty.
Nipun, if you can come again, there was some audio disturbance. If you can repeat.
Yeah, so what I'm saying is like based on my experience that I interacted with a lot of businesses around here, the key trigger points for a supply chain restructuring that companies are thinking is because of this pandemic, they were concentrated at say a particular place. Their manufacturing was at one location, their sales and marketing and logistics were in a particular location. And therefore, when this C19 came up, all of it came to a standstill. Now, what companies are looking at is a diversification. Now, they don't want to remain concentrated at one place. So, entities which have a manufacturing base in Vietnam, here a lot of companies in Singapore do their manufacturing from Vietnam. They are thinking of relocating some part of that to Malaysia also now. Logistics and marketing may still continue to be in Singapore. Some companies are thinking of shifting out the sales and marketing function to the location where there is a huge customer base. So it may not be easy, or it's not something which can be done overnight. It requires a lot of planning and a lot of documentation and a lot of justification from a commercial viewpoint. and tax and other regulatory issues need to be taken into account when taking the final decision, because it is not TP alone which they have to think about. The businesses have to think of a lot of things. So a lot of approvals need to be taken from the local perspective. Then they have to see the tax authority challenges also. So now Singapore tax authorities are very business friendly, but you move out, you see in the Indian context, in Indonesia, similarly, if you see, they are very aggressive like India. Now, Philippines has introduced a 84-pager note on transfer pricing audits only. Now, they have highlighted what they intend to do and how they want to carry out the audits. So there are some jurisdictions, again, from the comparability viewpoint, want only local comparables like India, Indonesia, Philippines. I've seen they are focusing more on local comparability. So these factors also need to be taken into consideration when doing the price setting when a restructuring is being undertaken. So I think for each business, they will have their own commercial justification to carry out this rejig of their operations.
Thanks, bro. Now, guys, coming to a very interesting topic, startups. We know there are a lot of startups which have come up recently, and because of C-19, some of the startups may be getting good exposure. They're running wealth, but maybe some startups, facing challenges, and in particular cash challenges. Now, I would like to shift to Jaydeep Menon on this. Jaydeep, what is your take on startups? What are the key issues they are facing, and how to overcome those issues? Jaydeep, over to you.
Thanks, Gaurav. Yeah, Gaurav, I deal with a lot of startups in UK, US corridor. So uh, they are massively kind of affected due to the COVID-19 implications. It's not much different from the bigger companies, but they have very different or kind of specific issues to deal with, apart from the common issues like cash crunch for expansion, kind of uh, uh, funding for their R&D, etc. Some of the other specific issues which they face typically in a startup scenario is these are companies probably having 2 or 3 kind of key employees. In the OECD concept, we call them the SPFs. These are the key employees who drive the company, and they are the main value drivers, either say the CEO or the CTO. Due to the COVID situation, the traditional headquarter location of these startups probably doesn't make any sense at all, because these guys probably have to move out to another new location because of the COVID situation, because these are the main employees who drive the company. Unlike bigger companies, they have different employees to deal with different situations. So these guys, see the CEO or the CTO, have to travel across the globe and then make sure that the business is live. So in a startup kind of scenario, what I've noted is the traditional transfer pricing analysis probably will not work. So we need to have a kind of more of a top-down approach, more like a value chain kind of approach, where we need to see where the significant people functions are located at different points of time throughout the year, because the CEO or the CTO can be locationally at different places, right? So that's one aspect which is kind of evolved during this difficult times. Another aspect of the startups and the mid-market companies are the impact on their valuation. So because of the developments, there are a lot of funding which is kind of withheld, and there's a lot of strain on the valuation which has happened for these companies. And because of which the traditional royalty model, which most of the tech startups follow for distribution of their software or their technology abroad, needs to get a relook, because the royalty payments are, end of the day, kind of on the generally done on the third-party sales at the respective region. Now, because of the COVID impact, probably there needs to be a different way to look at things. So there are certain cases where the tax authorities has to see whether the royalty payments can be forgone for a certain period of time, and even the management fee can be forgone for a specific time period, so that the specific local entities can come back into action and then they can recover from the COVID impact, and then start paying the unrecovered royalty or the management fee at a later point of time. Another two aspects which I would like to cover on startups is probably, again, as I said, the traditional benchmarking way of doing things may not work for startups and mid-market companies in the next 2 years. Probably they need to see whether they can take advantage of the safe harbor provisions in different jurisdictions more effectively. If the governments and the tax authorities can relax some of the safe harbor conditions, so that either in terms of the threshold limit to kind of be eligible for those safe harbors, or in terms of the kind of services which are covered, if they can relax a little bit for the startups and the mid-market companies, it'll be, I think, a huge hit. Unlike currently in India, I don't think it's a huge hit like an APA. The safe harbors are not preferred because of the high margin requirements in safe harbor and very strict condition in terms of threshold. If these are relaxed, I think it'll be a helpful a thing for the startups and the mid-market companies to have. And also, some of the companies are really reluctant to go for a detailed documentation at this point of time, because transfer pricing is probably not in the first in their agenda at this point of time, right? So they probably need to have a relook at the stricter documentation requirements and certification requirements in certain countries like India, where if they can be relaxed for the startups. In India, even for a ₹1 transaction, you need to have a certification. So if that can be relaxed for startups and mid-market companies, that will be of great help. Instead, they can be compliant by having a more kind of a shorter version of documentation where they cover the important things, by which they can be assessed on a kind of a risk-based analysis. I think these are the few things which I think will be more effectively kind of affecting the startup and the mid-market companies.
Jaydeep, I must say, you have got a lot of expectations from tax authorities. Earlier on the range concept, you want to have a wide range concept, and now on the startups, giving relaxations to the startups. Whereas, my other panelists are too much worried about the approach of tax authorities. So probably I must suggest that you must go to OECD and suggest them the recommendations, so that when they are coming up with their transfer pricing guidelines in relation to C19, they can include all of them. And maybe not many companies would like to see you as representative in front of the tax authorities to put their point. But very rightly mentioned, I can also vouch that for most of the startups, transfer pricing is not the key point, and their focus, in addition to startups, many of the the company's focus would going to be on running the show, then doing the compliance. But as we have discussed till now, the documentation would going to play a very important role. So whether it's startups or whether it's any stable company, for all of them, documentation becomes important. And OECD, when they are coming up with the guidelines in relation to transfer pricing for C19, they must come out with some specific issues relating to C19s. Very rightly, you also pointed out that one may have to relook into the royalty agreements or management fee agreements, and can they be deferred? The payments can be deferred for some duration, 1 year to 2 years. So guys, I think we are done with our discussion. We have covered all the points that we want to cover. Now, before we wind up, if all of you, can just in 1 minute to 2 minutes give your concluding remarks. So let me start with Belisa first. 1 to 2 minutes concluding remark for all of you, from all of you. Belisa, starting from you.
Okay, thank you. It was funny, yes, when I was asking the thought about tax administration here in Argentina, the tax administration recently issued a new general resolution that changed a lot of aspects of the transfer pricing requirement that companies have to prepare, and the deadline will be in less than a month. So here in this part of the world, tax authorities are not so friendly. And for example, here there is no possibility to use safe harbors, for example, and the company will have to, as Shay said, companies nowadays are not thinking in transfer pricing because they have more problems, bigger problems than transfer pricing, but tax administration from this part of the world will also want to collect as much taxes as possible, and transfer pricing will be one point that they are going to look for audit, and this particular year will be for sure audited in the following years. So from my point of view, as we all are saying, the key issue is to document everything, and try to plan every decision, also from a transfer pricing point of view.
Thank you. Charles, over to you. Charles?
Yes, Gaurav. 2 words. Talk to your advisor.
Okay.
Because this is a moving area. It's mobilis in mobile. I don't know if you remember the Captain Nemo, this adventurer who lived in a submarine. It was a fantasy novel in the 19th century, Captain Nemo, and he had a motto: mobilis in mobile, mobile in a mobile environment. And taxpayers, unless they have a complete tax department, can't follow all these movements of the OECD and in the COVID world. So I would say talk to your advisor, because the OECD is going to issue recommendations, guidelines at the end of the year to help tax authorities and taxpayers to deal with this COVID-19 situation. There is a review of the transfer pricing, funding, and financial and captive insurance and guarantee fees and hedging transactions on the plate. There are too many things, and at the moment companies are just trying to survive. So just talk to your trusted advisor. He'll help you. That would be my conclusion.
Thank you. David, over to you.
Even though there's a crisis, I think financial people need to keep the discipline of documentation, following the transfer pricing policy. Don't get carried away too much by just doing things, but maintain discipline in keeping that documentation. Okay. My message.
Jaydeep, thanks, David. Jaydeep, over to you.
Yeah, I think it's important that all the basics are still done in the right way. So starting from kind of reviewing the intercompany arrangements, taking a relook at the financing arrangements, I think those are very important. And then make sure that the story, what we write in the transfer pricing document is done up front, rather than 1 or 2 years later trying to get back the facts right. So I think these things are very important during these times.
Thank you. Nipun, what are your last words?
I think transfer pricing cannot go alone. So like if you see, the governments across the globe have been giving stimulus packages and incentivizing companies. So how the companies are accounting for that, what implication that will have on the pricing of the intercompany transactions, that I think that has to be taken care now, because a lot of these accounting aspects will be decided by the auditors now when they do the audit for this year. What conclusions they will draw, how will they disclose these costs in the financial statements. So I think all of this has to be looked at a holistic viewpoint and not only from a limited viewpoint of just the TP planning or a TP pricing part. I think auditors, what they conclude accounting wise and similarly TP wise. So that will bring a big picture when we face the tax authority challenge.
Thanks, Nipun. Thanks to all of you for contributing to this discussion. I personally believe it was a wonderful discussion, and I'm sure all the viewers, all the audience would going to love this discussion. They will going to gain a lot of wisdom from this video. With these words, thanks a ton once again to Belisa, Charles, David, Jaydeep, and Nipun for joining in today's discussion. Thank you, guys.
Thank you.